Hi friends, welcome back to EduTap. So today we are going to discuss some of the important MCQs which can be asked from this topic of buyback of shares. So let's start today's discussion. So the first question is, the provisions relating to buyback of shares of a company, they are contained in. तो shares के buyback को लेकर हमारे जो provisions हैं वो कहाँ पे contained हैं? Companies Act, SEBI regulations, annual report of company, both A and B or none of the above. A very simple question. थोड़ा सा सोचिए और आंसर आप आसानी से पहचान लेंगे. So let's try to understand about this concept of buyback of shares. So there is a company, okay, and let's prepare a balance sheet of a company. So balance sheet of a company, it always has two sides, asset side and liability side. On the liability side, we are going to have share capital, we are going to have reserves and surplus, we are going to have long-term borrowings as well as current liabilities. So long-term borrowings are going to be there and current liabilities are going to be there. Similarly, in the assets, we are going to have fixed assets and we are going to have lots of current assets, including cash in hand. So sometimes what happens is a company, it has some surplus cash. It has lots of surplus cash available with it. And it has no feasible investment alternatives. Where should the company invest this particular cash? So in those particular situations, and because of some other obvious reasons as well, the company decides to reduce its share capital. Suppose the share capital is 10 lakh, the reserves, they are 2 lakh, long-term borrowings, let's suppose they are 1 lakh, and current liability, they are 2 lakh. And here, let's suppose we have the fixed assets of 10 lakh, the current assets, they are of 5 lakh, okay, and the cash out of the current assets, let's suppose it is 3 lakh. So the company says, I am having enough of the cash with me. I do not have ample investment opportunities. So why not reduce my share capital? Okay, why not just pay back the money to the shareholders, or think of it from a different perspective. Instead of investing in another company, why not invest in the shares of my company only? Why not buy back the shares from the shareholders? So in this particular case, the company may decide to reduce its share capital. So it may say, okay, that I'll reduce my cash by 2 lakh and share capital by 2 lakh. So now the cash may decline by 2 lakh. It is going to remain 1 lakh. And the share capital after buyback, it may remain only 8 lakh. So this can be one of the cases, okay? When the company needs funds, it issues share capital, and sometimes the company also buys back the shares because of different sorts of reasons. And we are going to take a look at all those reasons in the upcoming slides. So what is buyback of shares? It means the purchase of its own shares by the company. जब company अपने share खुद खरीद देती है, that is referred to as buyback. So it enables the company to go back to its shareholders. Company जो है अपने shareholders के पास जा रही है. Company is going back to its own shareholders and offering them कि आपके पास जो company के shares हैं, sell them back to me. Company is telling this thing to shareholders. Now the provisions relating to the buyback of shares, they are contained in Companies Act and SEBI regulations. We have the section 68, 69, 70. Mainly 68 is the one which deals with the buyback of shares. And we also have the Securities and Exchange Board of India buyback of securities regulations of 2018, which deal with the different regulatory and legal aspects of the buyback of shares. Now let's look at the different advantages of the buyback of shares. So first one is it improves earning per share. You are already aware about the ratio, which is earning per share. Okay, how do we compute this earning per share? We have the profits. We have the profits which are available for shareholders. We have the number of shares. We have the number of shares, and we divide the two. We get earning per share. Okay, so if the profits for shareholders, they are, let's suppose 10 lakhs, and if the number of shares initially they are 2 lakh, the earning per share is going to be rupees 5 per share. Now suppose if we buy back 1 lakh shares, the number of shares, they are going to remain only 1 lakh, profits are 10 lakhs. So in this particular case, the earning per share is going to improve to 10 per share. So from 5 per share, the earning per share has jumped to 10 per share because the denominator, the number of shares, has reduced. We can also buy back shares to improve our return on capital, return on net worth, and to enhance the long-term value for the shareholders. So every kind of return which is calculated taking equity or share capital into consideration, this is going to definitely improve because now the amount invested is going to decline. To prevent unwelcome takeover bids. Now, if the shares of the company, they are actively distributed in the market, they are dispersed in the market. So in that particular case, there is always a risk that some hostile person may try to accumulate all the shares of the company. If the company buys back the shares in the market, they are going to reduce, and automatically we are going to reduce the risk of the hostile takeovers of the company. To return surplus cash to shareholders, like we just took the previous example, the company is having enough of the cash reserves and it wants to return it to the shareholders. Another reason can be to achieve optimal capital structure. So optimal capital structure is one which has a decent level of equity and decent level of debt. So if the equity level is going very high, so company can just reduce the equity by doing buyback of shares. So now this question can be easily answered. The provisions relating to buyback of shares, they are contained in the Companies Act and the SEBI regulations of 2018. So clearly the answer is going to be option number D. Now let's move to the next question. According to Companies Act, a company may buy back its shares out of. तो यहाँ पे पूछ रहे हैं कि कंपनी को अपने शेयर वापस खरीदना है, तो कहां से, किन सोर्सेस से द कंपनी कैन डू इट. Options are free reserves, securities premium account, proceeds of issue of any shares or other specified securities, any of the above, only A and C. So now we have to choose the correct option here. Now the Companies Act, it is very clear in this regard. It says that whenever a company is going up for the buyback of shares, then this has to be funded from the reserves and surplus of the company. So a company must have adequate reserves and surplus with it before going for buyback. Okay, so now it says that the buyback can be funded from the free reserves of the company, the general reserves, the retained earnings which the company has accumulated over the years in its profit and loss account. So all those which are freely available, they can be utilized. Securities premium account, it can also be utilized. So these are available for utilizing for the purpose of the buyback of the shares. Now in addition, there is another source which is available. Now this is the proceeds of the issue of any shares or other specified securities. So it is also possible to make an issue, collect money and make a buyback of shares. However, do remember this thing here, that buyback of any kind of shares or securities cannot be made from the earlier issue of the same kind of shares or same kind of specified securities. तो घपलेबाजी नहीं चलेगा. You cannot do कि previously जैसा शेयर आपने इशू किया, जिस तरीके का इक्विटी शेयर इशू किया, और अब आप उसी तरीके का इक्विटी शेयर जो है वापस से बायबैक कर रहे हो. सो दिस, इसकी टोपी उसके सर वोंट डू. दिस इज नॉट परमिटेड. If you have to buy back equity shares, then you can use preference shares for that particular purpose. You can issue preference shares, you can collect funds out of it, and then you can use it to buy back the equity shares. But it is not possible to issue new equity shares and out of the proceeds collected, redeem, repay, buy back the previously issued equity shares. So this cannot be permitted. This is not allowed. You cannot allow कि shareholder change कर दो, प्रीवियस शेयर होल्डर को पैसे वापस करके नए शेयर होल्डर से पैसे ले लो. सो दिस कैन नॉट बी परमिटेड. दिस इज नॉट अलाउड. सो दिस इज समथिंग यू हैव टू रिमेंबर. सो द थ्री सोर्सेज आर फ्री रिजर्व्स, सिक्योरिटीज प्रीमियम अकाउंट एंड द प्रोसीड्स ऑफ द फ्रेश इशू ऑफ सम अदर कैटेगरी ऑफ सिक्योरिटी. So now we can easily answer this question, that a company may buy back its shares out of free reserves, securities premium account and the proceeds of the issue of any shares or other specified securities. So clearly the answer is going to be option number D. Now let's move to the next question. This is about the accounting perspective with regard to buyback of shares. When a company purchases its own shares out of free reserves or securities premium account, a sum equal to the nominal value of the shares so purchased shall be transferred to the. So whenever you are doing this particular buyback, so a separate new account has to be opened in this particular case. We already discussed about this account in some other video as well. So now let's read the options first and then I will explain to you the accounting perspective of it. So the options are statement of profit and loss for the year of buyback, capital redemption reserve, provision for buyback account, goodwill account, or none of the above. So now let's try to understand about the concept of creation of a separate capital redemption reserve. So when we talk about the balance sheet of an entity, okay, we have to make a buyback. The balance sheet of the entity, it is going to have some assets, it is going to have the equity and liabilities. We are primarily going to focus on the equity and liability side. The share capital is going to be there. reserves and surplus are going to be there, and this is going to comprise of the free reserves. Okay, there are going to be certain free reserves. There is going to be a securities premium which can be there. Okay, so let's suppose the share capital it's of 10 lakh. Okay, the free reserves, let's suppose it is of 1 lakh, and the securities premium it is again of 1 lakh. So let's suppose this is the case here. Now, to maintain the capital structure of the company, we want that the capital structure of the company should not be adversely affected by the buyback of shares. So now we try to maintain a balance to some respect. So how this is maintained? So this is maintained. Now this is maintained by transferring the balance of the reserves and surplus to another category of account which is again part of the reserves and surplus only. So what we are doing, we are utilizing the free reserves and the securities premium to make buyback of the shares. And now for utilizing these, we have to transfer this particular amount to a separate account. Okay, we create a separate account, capital redemption reserve of rupees 2 lakh. Now the special aspect of this particular account is that this can only be utilized for one purpose. The free reserves, the securities premium, they can be utilized for multiple purposes. But this capital redemption reserve, we have kept the balance in the reserves and surplus intact. Okay, we created a capital redemption reserve, and the balance in the capital redemption reserve, it can only be utilized to issue bonus shares to the shareholders. No other use can be made out of this particular balance of the capital redemption reserve. So now, even after the buyback, the balance of the reserves and surplus, it is going to remain 2 lakh only. If in the future we convert it into share capital, then the share capital is going to increase, and again the capital structure of the company is going to more or less remain intact. So I believe the story behind it is clear to you guys. So it says that where a company purchases its own shares out of free reserves or securities premium. Okay, one thing you should remember here is that we talked about three sources of the buyback. Okay, 1, 2 and 3. Here we are only mentioning about the two sources, free reserves and securities premium. We are not talking about the fresh issue. We are not talking about the fresh issue here. We are only talking about the first two. If you are making a buyback out of these free reserves or securities premium, a sum equal to the nominal value of the shares so purchased, okay, a sum equal to the face value of the shares that you have bought back, it has to be transferred to a separate account which is capital redemption reserve account, and it has to be separately disclosed in the balance sheet of the company. So this is what is being provided here. The capital redemption reserve, the CRR, we call it CRR, this can be applied by the company in paying up unissued shares of the company to be issued to its members as fully paid bonus share. So CRR का इस्तेमाल कहाँ कर सकते हैं? केवल आप बोनस शेयर्स इशू करने के लिए इसका इस्तेमाल कर सकते हैं. Its use is very much restricted. It is not a free reserve. CRR is not a free reserve. Always remember, this is not free. So now we can easily answer this question that whenever a company is buying back its shares out of free reserves or securities premium, a sum equal to nominal value has to be transferred to capital redemption reserve. So answer is option number B. And now let's move on to the next question. As per the provisions of the Companies Act, debt equity ratio post buyback should not exceed. Options are 1:1, 2:1, 4:1, 5:1 or 10:1. Now let's take a look at the conditions for buyback. This is a very important topic. All the legal and regulatory requirements, they have to be complied with. So let's take a look at these requirements one by one. So first and most important is that the buyback must be authorized by the articles of the company. Every company has two main documents. One is memorandum of association and second one is articles of association. The memorandum has different clauses about the company, and it is mainly with regard to the companies working with the outsiders, the objects of the company and other things. Articles of association, this is about the internal working of the company, the internal rules and regulations. Now this articles of association has to permit the company that yes, it can go for buyback. Then is a special resolution has to be passed at the general meeting of the company. So there is a requirement of special resolution. Now special resolution means that we have to call the meeting of the shareholders and we have to take assent of the 75% of the shareholders. Now this may not be always practicable to take assent of the 75% of the shareholders. This is a very, very big number. So now it has been permitted that we need not pass a special resolution when these two conditions are fulfilled. Okay. when the buyback is 10% or less of the paid up capital plus free reserves. Okay, where the buyback is less than 10%, where the buyback is 10% or less of 10% or less of the total paid up capital and free reserves of the company. So paid up capital plus free reserves. Okay, if the total of these paid up capital plus free reserves इसका 10% तक का बायबैक अगर आपको करना है तो you need not pass a special resolution, you can only pass a board resolution. So the board of directors of the company, they can pass a board resolution at the board meeting, and this only would suffice. You need not pass a special resolution. So 10% तक का बायबैक करना है तो it is much easier. 10% of paid up capital and free reserves, do remember it. Okay. Now next point is the buyback is 25% or less of the aggregate of the paid up capital and free reserves of the company. So up to 10% if you have to do it with the board resolution. But if you do have to 25%, you have to do up to 25%. This is the maximum amount which is permitted. This is the maximum ceiling which is permitted under the law. The maximum amount is 25% of the paid up capital and free reserves. This can be done by passing a special resolution. Now another very important condition is with regard to the debt equity ratio. Now in the balance sheet of a company, on the equity and liability side, we have equity component as well, and we have this debt component as well. Okay, suppose the equity of the company, let's suppose this equity of the company is 10 lakh and this debt of the company, let's suppose this debt of the company is of 12 lakh. Okay, so now there is a considerable balance of the debt and equity in the capital structure of the company. If we compute this debt to equity ratio, this is going to be 1.2:1. This is a very comfortable ratio which is there. Now, if this ratio increases, okay, if the proportion of the debt as compared to equity holders, it increases in the capital structure of the company, it signifies that the company is getting more and more risky. It signifies more risk for the debt holders. It signifies कि कंपनी के ओनर्स का पैसा कंपनी में कम लगा है और बाहर से उधार लिया हुआ पैसा कंपनी में ज्यादा लगा हुआ है. Borrowed funds are more and owned funds are less. So if this ratio starts to increase, if the debt starts to pile up and equity remains same, or the equity starts to decrease, debt remains the same, then this is a risky proposition for the company. So the conditions for buyback, they clearly specify कि आपका debt equity ratio 2:1 से ऊपर नहीं जाना चाहिए. So after buyback, how much amount can you buy back in this particular case? How much amount can you buy back? Your debt equity ratio cannot exceed 2:1. So your equity can decline to 6 but not below 6. Okay, you cannot reduce your equity to a very minimal level. You cannot do like this, that equity remains only 1 and debt remains 12. So this is going to be very risky for debt holders. They are going to feel हमारे साथ तो बहुत बड़ा धोखा हो गया, equity वाले निकल गए, debt वाले फंस गए. So this is not allowed. Other conditions is that all the shares for the buyback, they are fully paid up. So no call money should be pending on them. Also you have to comply with the SEBI regulations. Another very important condition is that no offer for buyback shall be made within a period of 1 year from the date of the closure of the proceedings of the offer of buyback. तो buyback बार बार नहीं करना, एक साल में एक बार ही buyback आपको permitted है. One buyback per year, this is only permitted. No offer can be made again within a period of 1 year. So now we can easily answer this question that the debt equity ratio post buyback should not exceed 2:1. So clearly the answer is going to be option number B. Now there is a question and I would like you guys to answer this particular question. So there is some information which is given in this question in respect of a company. It says that equity share capital of a company is 20 lakh, free reserves they are 1 lakh, revaluation reserve 2 lakh, capital redemption reserve it is of 3 lakh. Up to how much amount the company can buy back its shares without passing a special resolution. So if you have understood the previous question, we have discussed about the company, it can go for 25% buyback by passing special resolution, and the company it can go for only 10% buyback by passing the board resolution only. This 25% and this 10% is of the paid up capital plus free reserves of the company. So this can be accomplished. So if the company is not interested in passing the special resolution, the company is only interested in passing the board resolution, then the amount of buyback it remains limited. So you have to identify how much amount would be permitted to be bought back by the company. So let me try to solve this particular problem for you guys. Okay. So equity share capital 20, free reserves 1 lakh. So total becomes 21 lakhs. Revaluation reserve and capital redemption reserve, they are definitely not free reserves. So now 21 lakh ka 10% is the maximum up to which you can buy back by passing the board resolution. So 21 lakh ka 10%, it becomes 2.1 lakh. So this is the maximum amount up to which you can buy back the shares. So now it was very easy to solve this particular problem. Okay, now this question would use this particular condition of buyback, that special resolution is not required if the buyback is up to 10% or less of the paid up capital and free reserves of the company, and such buyback has been authorized by the board by means of a resolution passed at its meeting. So board resolution plus 10% paid up capital plus free reserves का आप कर सकते हो special resolution बिना पास किए. Free reserves are those reserves which, as per the balance sheet of the company, they are available for distribution as dividend. Revaluation reserve, it is not available for distribution of dividend. It is not a free reserve. And also capital redemption reserve, it is not a free reserve. It can only be used for one purpose only, that is to issue bonus shares. So the free reserves that have to be considered are only the one that were simply stated in the question. So using that particular information, we did the calculation. And we found out that the maximum permitted amount is 10% of 20 lakh plus 1 lakh, that is 2.1 lakh. So clearly the answer is going to be option number A. So thank you friends. This was all about our discussion on the topic buyback of shares. I believe you guys have understood about this basic concept of the buyback. Why do the companies go for buyback? What are the main conditions that have to be fulfilled if you have to execute the buyback of shares? So that's it for today. Bye bye. Take care. All the best.